You're listening to the Bigcast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glenn Sarvati.
Welcome to another edition of the Bigcast. My name is Glenn Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology. And today we're going to be speaking with the founders of three early-stage startup companies that were finalists for our $25,000 prize last week at the Innovation Challenge competition at FinTech South that took place here in Atlanta, Georgia. And we're going to let you play along. I'll give you a little more details. I think this should be fun. I'm not going to mention who actually won during this program, and we'll let you actually vote and see what our audience thinks as well. Let me also tell you that you can always find out more about the Best Innovation Group by checking us out on our website, big-fintech.com. One thing you may want to check out there as well is our next CU Town Hall. And actually, you can get there through the website. You can also go straight to cutownhall.com. Last week's live stream we did from the America's Credit Union Strategic Growth Conference down in Austin was a big success. The fast-paced format where I have to count how many topics we actually managed to knock off in less than an hour. I think it was 10 or 11 in the Pardon the Interruption kind of format, if you're familiar with that from ESPN. We'll probably tackle that kind of approach again. We'll be back to our usual day and our usual cadence on September 17th, which is our usual Wednesday time slot. That will be at 3 p.m. Eastern Time, noon Pacific. It's free to join. You do need to register in advance, however, and you can do that at cutownhall.com. And if you go there, I believe there is a replay of the live stream from last week at the Strategic Growth Conference, which you can check out as well. A couple of quick news items, two quick ones I want to make sure because I think they're a pretty big deal. And they're both what I would call developing stories. I'm not sure we have the full story on either of these yet, but we'll post some links so you can read a little bit more about them, and I'm sure we're going to be coming back to them too. This one just broke on Friday afternoon. Visa is closing its open banking operation in the U.S. One of their quotes says, "We are going to be focusing on high potential markets like Europe and Latin America." Ouch. With all the talk about open banking, for a player like Visa to basically kind of cry uncle, I thought was pretty interesting. And you have to say Visa's in a little bit of a sticky situation, given that they are, the banks are their biggest customers, the biggest card issuers, et cetera. And the banks seem to be at crosshairs right now, in the crosshairs, or at cross purposes with the fintech companies in terms of exactly how this is going to work. The Section 1033 law has been revoked and is now being rewritten. We'll see how that comes out. The total lack of regulatory clarity, I'm sure, is what really drove their decision. I think they kind of just said, okay, let's just let the dust settle and figure out what's going to happen on this, and maybe we can come back and revisit it in 6 or 12 months or whatever. There's been all that conversation about Chase deciding to charge for access to the data, which, of course, was not allowed according to the rules of 1033, which I believe was one of its flaws, particularly given that you could not cost recapture for the effort to make that data available. And there are now reports that PNC is looking at going down that same path. So that's where things get interesting. As I say, I'm sure we'll be following on. We've got a couple of links that we'll post on that one. I think Reuters did the best job, and I'll post that link to what they had to say. The other one that popped up last week that caught my attention, well, several things caught my attention, but this one kind of rose to the top of the stack. Wyoming has launched its own stablecoin, the state of Wyoming. They're calling it the Frontier Stable Token, abbreviated FRNT, I'm assuming front for short. It is already, according to the release, it is live on 7 blockchains already, including the well-known Ethereum and Solana chains. And it will supposedly be usable wherever Visa is accepted. But, and this is interesting because it kind of gets a little bit buried in there, and I'm not really sure why such a big deal is being made out of this in terms of press releases right now. The press release goes on to say that, quote unquote, due to lingering regulatory hurdles, it is not yet available to the public. If the blockchain's not available to the public, or the coin's not available to the public, I'm not exactly sure why we're talking about it so much. Jason Mikula, our friend who runs FinTech Business Weekly, did a really good thought piece on this one, basically saying, what exactly is this for? Who is this for? And if you run down a path of every state issuing its own stablecoin, which is probably where we're getting into that regulatory hurdle when you think about the definition of currency, it raises some interesting questions. What exactly is the end game here? Including traction, critical mass, a single accepted use of a coin. Great experiment. Let's see what happens going forward. Obviously, Wyoming's been kind of at the front of the pack on this stuff for some time. So again, we'll post a link to Jason's article at FinTech Business Weekly, and I believe he's going to be at Finovate in a couple weeks. I'd love to catch up with him and talk about this one a little bit more. Let's get into the main event. The Innovation Challenge is something that's been going on here at the ATDC, the Advanced Technology Development Center at Georgia Tech now for, I think this is the 11th or 12th year. I've been happy to participate in that the last several. This year we had 9 startups that went through a 4-week accelerator program. I served as a mentor to one of them, not one of the ones that we'll be talking to today, just for full disclosure. At the end of that 4-week accelerator program, they all gave 5-minute pitches to a group of judges. I believe it was 4 judges with Q&A, 5 minutes of Q&A after a 5-minute pitch. Those judges narrowed that field down to the top 3. And I do have to say, and this sounds like a platitude because people always say this, in all the years I've been involved, this was by far the strongest group of, top to bottom, the depth of the solutions and the teams that are out there approaching these pain points and trying to come up with solutions, I thought was just wonderful. I truly had a hard time. I thought that virtually every single one of the companies could have been part of the final 3. But those top 3 wound up being selected, and then they pitched on the main stage at FinTech South on August 19th to a different group of judges, which included members of representatives of Coinbase Ventures, TTV Capital, Deluxe Corporation, and CAFE, which is the Center for Accelerating Financial Equity. So a really good cross-section of folks that it'd be very interesting to see how they, kind of came to a consensus on these different companies. The final 3 were companies, and I'm going to just record or present my interviews with them in alphabetical order: Lulo, PromptWorks, and ThriftShip, and talk to each of them after the competition. And I think we covered a lot of what was actually in their pitches. Why don't I give you a chance to hear these directly from the founders themselves? I think it's fascinating stuff. Let's start off with Sarah Stellwag, the founder of Lulo. I'm here at FinTech South with Sarah Stellwag, the co-founder of Lulo, one of the finalists yesterday from the Innovation Challenge competition. Congratulations. I thought the presentation went great. It was fascinating stuff.
Thank you very much. I appreciate it.
So a very, I think a pretty unique model that you don't see very much at these solutions. I think maybe you can help describe, this is an app that helps recipients of WIC benefits, women, infant, and children. I'll let you take it from there.
Yeah, so Lulo is for families who are eligible for the Women, Infants, and Children Benefit Program, or WIC. And WIC is unique because it mandates the brand, size, and type of food that families can buy, so they often struggle to know what they can purchase. What that looks like in practice is the 12-ounce box of Cheerios might be approved, but the 10-ounce box isn't. And the regular Cheerios are approved, but the Honey Nut aren't. We found this creates an incredibly painful grocery shopping experience for families to navigate all these different convoluted program rules. So the Lulo mobile app takes their unique benefits information and matches that with exactly what they can get in the grocery store, and it helps families put more food on the table. And
the idea also is you avoid kind of the awkward situation at checkout where, I know that's one of the scenarios you kind of lay out in your pitch. You actually can look, while you're in the aisles and make sure that you've got the right product.
Exactly, yeah. So our team spent hours upon hours, and with hundreds of families in New York actually starting out, going grocery shopping with families. And almost every single family that we talked to had this experience of going up to the register, finding out that an item they got is the wrong size. The transaction freezes, their kids start crying, people are talking about them using benefits. And it's this incredibly stigmatizing experience where you just want to get out of that store. And so we found families are leaving almost 40% of their benefits behind every single month because of that kind of information asymmetry and also fear. And so with the Lulo app, they can connect their benefits. We show them their balance in real time. They can scan an item to instantly check its eligibility. And we also show an entire catalog of products with their dietary information, nutrition information, and really help with that discovery of all the different kinds of brands that they can get with WIC.
It's an interesting model, too, because from a revenue standpoint, the revenue model, you were thinking, okay, we're helping people who are actually on support systems. You see an opportunity with consumer packaged goods, CPG. They're the ones that are actually coming to you and looking to actually reach this audience, which I don't know that people would necessarily have assumed.
Yeah, absolutely. So when we look at that moment at checkout where that family isn't redeeming their benefits anymore because of that stigmatizing experience and that confusion, that means that retailer and also that food manufacturer miss out on the sale. And what we found is a lot of the food manufacturers are spending some of their dollars and funds to be able to try and reach WIC administrators and hope that that information trickles down to families, that this product is approved. What's also unique about the WIC customer is they're not price sensitive. Because WIC isn't based on a dollar amount, it's based on kind of set amounts like ounces of cereal or gallons of milk. That means that a WIC customer doesn't really have to worry about the price of something. So it's this really unique moment for a food manufacturer to be able to reach a non-price sensitive consumer and really early on in their family's kind of eating journey and habit development.
So you're actually dealing with creating loyalty at a very early stage for reasons that they'll probably feel very loyal if someone's helping them out at their time of need and they age into a situation. And speaking of aging into a situation, you came to this solution. You worked at another similar app that addressed other kinds of needs in the social service area?
Absolutely, yeah. I came and I previously was a product manager at Propel, which has a mobile app that helps 5 million SNAP households manage their benefits. So Propel started because the 1-800 number on the back of the EBT card was the most called number in the US. And there wasn't really a seamless way to be able to keep track of your food stamps balance. And so they basically created a mobile financial app that allows people to check their balance and kind of manage their SNAP benefits every month. And while I was there, I noticed that the WIC program in particular was lagging behind in terms of modernization and wasn't really getting a lot of attention. So for example, in Georgia, there was a transfer from paper vouchers to get your WIC benefits to the eWIC electronic benefits transfer card just in the past few years.
And that passes for, state of the art. That's as far as we've gotten.
Exactly, yeah.
So the WIC is, I remember seeing the chart, that's the smallest, the core area that you're really beginning with because it's the greatest pain point. But then you've got a strategy to kind of build out from there.
Absolutely. So we know WIC is the most complex benefits program and has the most acute pain points. And so that's why we see it as it creates a high barrier to entry and a really strong initial wedge for us. But we know WIC doesn't cover a family's full monthly grocery shopping needs, right? And so our plan is how do we capture that full basket by starting with WIC and helping families kind of maximize across that. But we know a lot of our families use SNAP as well. And
Can you just define SNAP as at a certain age bracket for the children? Is that what's the criteria where you move from WIC to SNAP?
Yes, you can receive WIC and SNAP at the same time. It's all about just income verification, but WIC you can only receive up until your child is the age of 5. So you do age out of that. But, all different kinds of Americans, 42 million of them receive SNAP benefits.
And if you've got a child under 5 and the child over 5, you could be getting WIC and SNAP at the same time.
Exactly.
Got it.
Yeah, exactly. And so being able to kind of increase that basket sizes and also think about the price sensitivity that kicks in with other kinds of grocery shopping behaviors is what we're thinking a lot about as we expand the product and kind of on our roadmap.
And speaking of expanding, and there's a lot of different directions for expansion, you started this in New York City. And I guess because I think you've mentioned, because there's no geofencing it's word of mouth that's gotten this app out there, you started to see these other hotspots where you were seeing the most interest in the app.
Precisely. We aren't able to geofence it, and so we were seeing all of these downloads come from the Southeast and in Georgia in particular. Part of the reason is the Georgia state government doesn't currently offer an alternative app, and so we were seeing a lot of families trying to download and use Lulo. And so that became our focal point as the next place to expand. And as we've seen it kind of take off organically and through word of mouth, that's why I moved down to Atlanta here, because how do we be closer to our families, and especially as we think about expanding to more states and those in the Southeast where we've seen a lot of traction, it's all about deeply understanding that user experience and getting as close to families as possible.
So you've got some great knowledge already of where the logical next expansion points are because you're seeing direct expression of interest from the end users.
Exactly, yeah. We're able to directly quantify which states people want us in next based on the number of downloads and people that are trying to use the app there.
So when you think about your next, and you've bootstrapped this to a great extent. I mean, you've not done any formal funding. I think you mentioned you might be looking at an angel round, but the next round of money would go toward actually adding more states to the mix?
Exactly, yeah. So we have a really clear expansion plan, and so that's where the kind of angel round would come in to help us close some of those gaps, just in terms of our product development and helping us be able to reach that next stage. We've shown that we've mostly grown organically, and then when we pour a little bit of fuel on that fire, our acquisition cost is below 35 cents a user. And we have a lot of customers that are lined up just waiting to see this expansion kind of materialize. And so that next round of funding is going to help us expand, grow the number of monthly active users, and unlock a lot of contracts that are in our pipeline.
And then on the other side of the equation, the CPG, the consumer packaged goods firms, which is a primary source of your revenue, is they want to reach more. So they're actually, I guess, they're kind of like, let us know. A few of them are very interested already. Some are saying, when you get to certain critical mass and can reach more states, sign us up.
Exactly, yeah. So we have a few targeted campaigns that are set to launch this quarter. We have one with a major CPG brand and one as well with a Lifeline phone provider, so another benefit that our families can access. And so those are really going to be our core case studies that are going to help us grow this. But yeah, we have multiple CPGs in the pipeline that are interested and just waiting to see that scale, which we're working towards executing on.
How much cooperation do you need from the states to actually work on this?
We don't need any cooperation from the states, but we like to say we're building with the state in mind and keeping them in the loop, because we're really taking this as an ecosystem approach of, if we build this better, we're alleviating some of the pressure and burden on local agencies and also improving general health outcomes and the delivery of the WIC program in general. So we like to take into account and are building in mind with what are the state's goals and priorities and how do we best align to be able to meet those, and constantly looking for ways that we can be collaborative and opening our door to sharing insights of what we hear from families.
And the rules change from state to state too as well. So my understanding, you've got to actually build out your database of which products qualify in each state. So you've got to get that information. Actually, that's another barrier to entry if you've built out that database.
Exactly. So every state manages an approved product list, which has a list of thousands upon thousands of UPCs. And so we've been building out a database that has that across different states, as well as with pictures, nutrition information, dietary tags, et cetera. And so being able to kind of build that out is helping us move faster in terms of turning on new states.
Fascinating stuff. If people want to find out more, what's the best way to get in touch?
Yeah, best way is to check out our website. It's called hellolulo.com, hello, Lulo.com, or follow us on LinkedIn as well.
Sarah Stowaway, co-founder of Lulo. Fascinating stuff. Thanks so much.
Thanks so much, Glenn.
Okay, on to the second competitor in alphabetical order, PromptWorks, dealing with a very different pain point. And this is co-founder John Utz. I'm here with John Utz, the co-founder and CEO of PromptWorks, one of the three companies that was on stage as the finalists for the Innovation Challenge competition at FinTech South. And a very interesting solution, and one that I've been following along over the course of the last few weeks through the Innovation Challenge 4-week exercise. John, thanks for taking the time to talk.
Yeah, absolutely. Thanks, Glenn, for having me on the show.
Well, I think you do a great job of kind of laying out the pain point and the mission that you're undertaking by using, and this is a healthcare, health tech finance solution, I guess might be the best way to put it. But you use a great analogy of something as simple as going out and trying to buy a cup of coffee. Why don't I ask you to kind of start there to frame the situation?
Yeah, sounds good. So for a moment, imagine you're in your favorite coffee shop. When you buy your coffee, you tap your card, the transaction takes maybe a second. The coffee shop pays a small, predictable fee, maybe 3%, and they know with certainty the money is going to be in their account tomorrow, the next day. It's pretty simple. Now imagine for that same cup of coffee, you had to submit a claim. The shop had to wait 45 days for payment. They were only paid 85% of the time and received a nice note with the payment that said the caffeine wasn't medically necessary. And to get the rest of their money, they had to hire a team of experts to write a multi-page appeal, all while paying about a 20% swipe fee. And I know it sounds absolutely absurd, but that's unfortunately how our close to $5 trillion healthcare system in the US works every single day. The simple act of getting paid is just broken.
And that's the bottom line. The healthcare and I think that's no surprise to anybody, but you've got more of an inside kind of scoop, inside window into this. The healthcare remittance process is broken. Another piece to kind of get into, you and your partner Vio both you've kind of switched sides of the battlefield is the way I'm thinking of it, because you had an inside view of some of the insurance companies, the payers that are in the form of doing these denials.
Yeah. So Vio and I both have worked in the health plan space. We both participate in building a lot of the AI systems for payers. Or seeing how they're constructed, how code edits are done, how claims are reviewed, how prior authorizations are reviewed. And, no fault of the payer, they have to review tens of millions of transactions a day. So they need to put AI in place. But unfortunately, in doing so, yes, they do cause a lot of challenges for healthcare providers in getting paid. It's very complex. And so Vio and I thought, well, we could go and take our, capabilities and knowledge and help payers, but we decided to switch sides, help providers get paid, which ultimately helps consumers because if a provider can't get paid, guess who foots the bill? Unfortunately, it's you and me, the consumer, when the payer doesn't pay the claim.
In one form or another, higher insurance costs, direct
Yep.
billing, and medical debt, et cetera. But I think one of the things I really found interesting is although you're representing the providers in this scenario, you're approaching it more from the payer mindset, which I think is a really novel way of looking at it because you understand how the system works.
Yeah, I think, it's sort of an interesting insight and a pretty basic one at the same time. The problem of getting paid as a provider, it doesn't result necessarily from what the provider does or looking at historically how the provider's gotten paid. The challenge comes from the payer, what happens in their system, in sort of the black box of the almost infinite combination of rules and edits and policies they haven't sort of really solved the problem of getting a provider paid. You have to think like the claim analyst at a payer or think like the software at a payer. And that's, a really important insight. I would also say payers do want clean claims submitted. They don't like claim rejections and denials because it creates rework on their side as well. So being able to think like the payer, like the analyst, ultimately does help the provider get paid, but it also reduces work on the payer side.
Makes
So it is
sense.
really important.
And you're making good points. It's not we're not trying to cast pure evil. There's like you say, they're dealing with millions and millions of claims. So of course they've got needs to try to simplify the process
Sure.
as well.
Yeah, and every provider has a very specific and complex contract with each payer. So there are a lot of things that go in place that make it challenging on a provider by provider basis for a payer as well.
So just to kind of frame the problem, you mentioned I think before a $1 trillion problem overall, but you're attacking the denial piece, which I believe I remember hearing was $260 billion annually.
Yeah, that's correct. So about $1 trillion a year is lost somewhere in the payment life cycle in healthcare in the US. And then, yes, we're very focused on 25% of that, the $260 billion in denials. For a hospital, unfortunately, that's a nightmare. The average hospital loses tens of millions of dollars to denials. They just don't have the time or the resources to work them. They use software from the 80s. It's 90% manual. It's really challenging, and it's really an expensive, inefficient, and demoralizing fight for them because they only win about 40% of the time. So like if you're in any other business, you've earned the money and you still can't get paid after putting a hard fight in. That's sort of a demoralizing thing to have to deal with.
And beyond that, it's just kind of the nuisance fee as well. I'm just thinking several of those, if you have to put the manual effort into the appeal process, unless it's a certain amount, you're probably just going to go, you know what? Even if I win, I'm going to actually spend more money claiming the money. So I'm just going to let it go.
Yeah, absolutely. I mean, there are a lot of claims they just write off because they're not worth going after. It'll cost them more in labor costs or transaction costs plus labor costs to actually get paid. So, general rule of thumb a lot of times is under $100, sometimes even under $200, they don't even bother, which is a lot of money they lose because they just don't have the time, resources, or it's too expensive to go after.
Now, I was very impressed. I understand you're already at an annual revenue run rate of about $1 million. You're live in market. Your
Yes.
your sweet spot, from what I understand, is I think the mid-market hospitals. I forgot how you exactly defined that. Where this is even a greater existential threat than it is for the behemoths.
Yeah, I mean, for a lot of hospitals, especially the small to mid-size community, single location, or maybe small number of location, they don't have the resources of a big hospital like a Cleveland Clinic. They don't get the attention from the big software companies or providers, of solutions for this specific problem. So yeah, they could potentially lose tens of millions, if not, $100 million a year, depending on their size. they don't have the ability to go after it. And for them, especially the small single community hospitals that are on the lower end of revenue, could mean the difference between them being able to stay open and having to close their doors, which when you're in a rural community and you're the only game in town for 100 miles, closing your doors, that's a huge problem for everyone that lives in that area.
So what are your next steps? I know you're actively courting more contacts at these size hospitals to really make one thing came to my mind. I don't believe this is your model, but it seems like you could actually work almost on a contingency fee, but that's not your model, right? You actually charge on per claim. Is that the way it works?
We do have a small contingency fee and a per transaction cost, which is substantially lower than, paying somebody to do it on a labor basis. We have entertained, honestly, although we haven't put it out there yet, that we are looking at pure contingency model. So it is something we've thought about, and I think eventually we will get to, specifically for denials.
Got it. But right now you're looking to really contact more hospitals, but I think you mentioned to me you're also exploring opportunities, maybe partnering with some other fintechs too.
Yeah, so we are really interested, given we're sort of a crossover of a health tech fintech company. We're really interested in potential opportunities to partner with more traditional fintech companies who work with hospitals and healthcare systems, whether it's on payments, check processing. I think there's a ton of opportunity to partner in this space. And yes, we are also obviously looking to talk to hospital CFOs and VPs of revenue cycle, potential investors, but I think it's really an interesting opportunity maybe to bring health tech and fintech together to solve a big problem for both healthcare providers and consumers.
Agreed. So if people want to find out more and get in touch, what's the best way to do that?
Yeah, best way to do it is just go to our website. It's www.promptworks, prompt, PROMPTWRX.com. Or they can shoot me a text, 908-956-2665.
I don't think anybody's ever given off their mobile phone number on our podcast before. It's a first, and I like that. John Utz, CEO, co-founder of PromptWorks. Really enjoyed your presentation. Thanks for taking the time to follow up.
Yeah, thanks, Glenn. Appreciate you having me.
And finally, but certainly not least, ThriftShip, a company that got started right down the road here. Actually, all of these have started kind of right down the road, but this one in Athens, Georgia, part of the University of Georgia, a student actually, and even before that, as you'll hear, Valeria Brenner, the founder of ThriftShip. I'm here at FinTech South with Valeria Brenner. She's the founder of ThriftShip, one of the 3 finalists for the Innovation Challenge Awards. Thanks for taking the time. We finally find a quiet corner here at FinTech South. Why don't you tell a bit about your entrepreneurial journey starts all the way back in high school?
It does. So I, in high school, started a thrifting account with 2 friends. So what we would do is we'd go to Goodwill or Salvation Army. We'd source clothing or pieces of home decor that we found cute. We either upcycle them or keep them as is, take pictures and then post them on this Instagram account. And then people would just comment in order to indicate that they wanted to purchase. Within the span of about 6 to 8 months, we had scaled 2 different Instagram accounts as a team and then individually to about 28,000 followers. And we each were doing around $4,000 a month in revenue.
This is as a high school kid.
As a high schooler,
wow.
Yeah. But very quickly it turned into a nightmare just because we outgrew the amount of hours that we as individuals could kind of work. And so we were losing out on sales left and right, and we kind of hit a plateau in terms of growth.
And I think what you're nailing here is the pain point at a kind of a Gen Z thing that might be outside my typical line of sight. A lot of solutions now, kind of Shopify has come up, things like that. But you're actually dealing with a different pain point because every single item that's being sold in these kind of scenarios are unique. It's not like you can set up an SKU and just run through these volumes.
Exactly.
So that's what you're helping is people who are in these types of businesses, and there are a fair number of them with those same kind of challenges.
Yeah. There's roughly 4 million people just on Instagram alone that sell individual unique pieces, whether it be, vintage or secondhand, or if it is things like pottery, jewelry, things like that. And they're doing, or at least just resale. It's tough to find numbers on this market, but with just resale in 2024, $4 billion was generated by people doing secondhand sales individually on Instagram and Facebook.
And the key here being Instagram and Facebook, because one of the questions I remember from one of the judges was, why doesn't someone go to Shopify. And I think you have a very obvious, not obvious to me, it was not obvious to me, but the answer to that.
Yeah, I kind of have like a three-pronged answer to that. One being it adds friction to the buying process. So the customer now has to, instead of just comment on an Instagram post, go to that account, click on the website, scroll through the website, find the item, et cetera, et cetera. And so the buying, I guess, conversion rate or whatever we want to call it decreases. We've seen it happen with reselling accounts that graduate, quote unquote, into a Shopify account, and then 2 or 3 weeks later they go back to selling on Instagram because their sales have absolutely tanked. Kind of the second reasoning behind this is, like you mentioned, that SKU problem where every single item you sell is unique. That means double the work for the seller. They have to post everything to Instagram once and then upload it to Shopify again.
And no scaling at all, because as soon as it sells, that SKU is gone and you got to put up the next one.
Exactly. And then kind of my third and final answer to that is branding. So when you start an Instagram business, you're creating a business, but you're also creating a brand for yourself, and customers really, really resonate with that. And so if you take them off platform, you're actually removing the branding aspect of your business. And so it just separates customers from the experience of buying from you as an individual, as a brand who owns a business.
So the solution of ThriftShip is actually allowing that payment transaction to take place within that workflow, within the social media account.
Exactly. The way it currently, or I guess used to work, is that people, comment on these posts and then they move that conversation with the seller into DMs or direct messages. They talk a little bit back and forth, and then the seller actually sends the customer off platform to Venmo, PayPal, Cash App to then send the payment. And there's so many extra steps involved.
And reconciliation.
Exactly, because you as the merchant then have to go in, double, triple check that the right person paid you the right amount. You're also trying to reconcile Instagram handles with Venmo usernames and also like regular like actual names. And so there's a lot of just chaos happening. The most common way we see that merchants keep track of their sales and orders and all of these things is through screenshots and then physical notebook paper where they just have line items where they put a checkbox
Which,
to indicate.
if you're selling a dozen items a week, may not be bad. If you're scaling to $4,000 and $5,000, then you get a different story.
Exactly. So like our top 20% of our customers, they do anywhere. So we start them at like 30 plus orders, but we our top customers tend to do around like 250 to 300 orders a month, and it's just an absolute nightmare. And oftentimes at that point, then usually they bring their spouse in to help them, or an assistant, or they bring a partner on to kind of share the workload. But for people who are just doing it by themselves, we seem to hit a plateau around 60 orders a month, because that is the amount of hours in the day that you can physically like handle all of these manual processes, which is with comments, for example, every time you post an item, it functions very similarly to eBay, where you have 24 hours of bidding. So that means if you posted 20 products for a whole day, you're glued to your phone responding to every single comment across those 20 products, letting people know if they've been outbid, if their bid has been accepted, if they've won that bid, then reaching out to the winners, following up with them, trying to make sure nobody slips through the cracks. And all of that really tends to add up. And what we've seen is in a 40-hour work week, around 18 and a half hours are consumed by manual processes such as these.
So you kind of shifted, you went to University of Georgia, and
Go Dogs.
We are just down the road here in Atlanta, and you majored in entrepreneurial studies. Am I remembering that correctly?
No, I did marketing and international business. I did end up adding a certificate of entrepreneurship just because I found the whole process so interesting and I wanted to kind of be involved there.
But you actually managed to use this as one of your case studies for project, real world, getting credit for the real world of what you're doing.
That was my favorite thing about what I was studying, especially because I'm really big into marketing and then as a result customer discovery, so talking to our customers, understanding who they are, what their pain points are, and how we can kind of ease those pain points. I'm very against people building a solution first, because it could be the coolest product in the world, but if nobody uses it, it's just a sad waste, I guess, of potential. And
you made a really interesting comment to me a couple days ago when we were talking as well, that you are, you go back now and you think about your original V.1 product that you put out that was, you're embarrassed by it. But you're saying if you're not embarrassed by your minimum viable product, you're probably not iterating fast enough, which I think is a really good way of thinking about it.
Exactly. In the words of one of my professors and mentors, done is better than perfect.
Yeah.
And so that's kind of
I could
words
probably
that
learn
I
that
live
one
by.
myself.
Yeah. I think it's so easy to get into feature creep and want to keep perfecting it, but just as long as it solves the pain point initially, you can always build on it, make it better, make it prettier. But if you keep like holding back and delaying yourself because, oh, it could just be a little bit better, it could work a little bit smoother, then like you're never going to get anything out the door.
And in that regard, I mean, obviously Thrift Shift is in market. What is, and you've, as I'm remembering, you've kind of got a three-pronged revenue model as well. Can you talk a bit about your traction, what your volume is now,
So
how you bring in revenue?
Formally launched kind of our 2.0 in January of this year. We've been growing 10% month over month, so 36 quarter over quarter. We have 350 active monthly merchants that are doing now about 7,000 packages a month. Our revenue model, I call it an internal customer acquisition funnel. So at the very top, we have shipping labels. So we have a partnership with USPS that lets us earn a commission on every shipping label sold.
And again, you're selling another pain point for these, because they need to go out and get these labels.
Exactly, and so it's cheaper and faster than going to the post office because we also offer discounts on those label
prices. Cheaper for them, and you get a royalty in the process.
Exactly. And so that's the top of our customer acquisition funnel, where any business, big or small, does need to ship out their products. And so if we make that a free to use service for them that we earn money on, it's a great way to get people into the top
I didn't
of the
even
funnel.
get that. So you're doing that even for people who have not availed themselves of the rest of your services.
Exactly.
I didn't get that. Okay.
And so what we've seen there is that as customers grow, from 5 to 10 to 15 products a week, they start experiencing more of the pain points, and they trickle down into the next part of the funnel, which is the payments processing portion. Meaning, rather than sending customers off platform to various different payment apps, they can now consolidate everything through our payment processing, which is powered by Stripe Connect. It helps with fulfillment times as well, because if you have your balances across like Venmo, Cash App, PayPal, there's a 2 to 3 day period before that balance actually transfers to your bank account, and then you can use it to buy labels. And so if you can use the balance you have in Thrift Ship to buy your labels, that saves on payment processing fees and also lets you just fulfill orders a lot faster. And then finally, the last step of the funnel, which we see people trickle into or are expecting people to trickle into based off the conversations we've had with our customers. When they hit around 20 orders to 25 orders a month, they tend to really feel this pain point of all the manual messaging. And so they adopt our SaaS subscription model, which is then that agentic AI portion that we talked about yesterday or pitched yesterday. We're in the process of building that out, but what that does is it eliminates all of that manual back and forth conversation that doesn't actually build on the customer experience. So what I mean is it responds to comments saying, you've been outbid, it manages bidding essentially. It reaches out to customers with checkout information, and it can process the entire payment in chat and on platform, meaning there's no links involved. It's just, hey, we have your address on file. Is that one still good? Hey, we have your card on file. Can we charge you, $25 for that product? And we just streamline that entire process, remove all the friction, and then I always say it's like minimizing the manual nightmare, and it's maximizing the customer experience, because then you as a brand owner can still post on your Instagram, can have genuine interactions with your customers, and not waste any of this time on these tedious sales processes.
And that is not live yet, but that is coming. That'll be V3, I guess?
Yes,
okay.
yes. And so that's about a quarter out from being finished, but we're working quickly, and we're doing it in steps essentially, and releasing it one by one.
Again, done better than perfect.
Exactly.
You'll have something out there,
Exactly.
You'll iterate from there. So I know you've recently started a funding round.
Yes.
Best way for people, tell us a bit about that, and then the best way for people, whether they're interested in your product overall or maybe as an investor, how they get in touch.
So we are, as of 2 days ago, opening our pre-seed round. We're raising $2 million, and that lets us get to $2 million revenue. So it'll help with marketing costs to 10x our growth from 350 to 3,500. Just for quick context, all of that growth has been organic. We've not spent any money on marketing yet, but then we've been also really looking in and digging into how to spend that money based on how organically our customers have come to us. And then also expand our engineering team and just accelerate the development process so we can get that third revenue stream out the door. But,
and it's Thrift Ship, thrift with a Y.
Yes, because we're quirky, is what I always say. I can be reached through LinkedIn, so Valeria Brenner, or on our website, thriftship.com, and also through email, just valeria@thriftship.com.
Valeria Brenner, Thrift Ship. Fascinating presentation. I think a really interesting pain point you're dealing with, too.
Thank you. Thank you.
So there you have it. I found each of these. I honestly could tell you that after I saw the three on-stage presentations, I really didn't know who was going to win. I thought they all deserved to win. And when I really thought about it, it came down to, I'm not exactly sure which kind of criteria the judges really prioritized. And maybe the four judges had different criteria. I know the judging criteria they were told to look at, but I mean, that still leaves an awful lot of latitude. Do you put more weight on one than the other? I think that each of these solutions maybe kind of indexes a little bit more heavily on one aspect than another. If you're thinking about social impact, investability, potential for a big payout, et cetera, business to business. I mean, they're very different. So it's interesting to kind of see. And that's where I'd like you to get involved. We have set up a landing page on the website. If you check out our show notes, which I always encourage you to do, as I said, we have some links as well, both to all of these companies, as well as to the news items that we mentioned at the beginning of the episode. But if you go out there, there's going to be a link where you can go and place your vote of if you had to pick, if you were judging which of the three you would have awarded with the Innovation Challenge $25,000 non-dilutive grant to advance their company. Which one would you have picked? Once you vote, you'll get a chance to see what our other listeners have picked. And then I'll also provide a link there where you can click through and see who actually won. As I said, I believe all were truly deserving. And I think they're all going to be going forward and doing some really wonderful things. So we'll be following up with that. With that, and probably a little bit longer than usual, because we had some really, really good extensive content this week. Another episode of the Big Cast in the books. Again, my name is Glenn Sarvadi. You can track me down via my firm, 154 Advisors. You can find out more about the Best Innovation Group at big-fintech.com. We're both active, all active on social media, LinkedIn, Blue Sky. At JB FinTech is our Grand Poobah John Best's handle, or at Big FinTech for the Best Innovation Group overall. We are going to be taking a break. It is Labor Day coming up next week, so we will not have, for one of those rare occasions, we will not have a new episode on Tuesday. We typically have new content every Tuesday, and we appreciate if you track us down wherever you get your podcasts, Amazon, Apple, Spotify, etc., and like, subscribe, whatever they ask you to do there, so you always know when we've got the new stuff out. We will be back the following week. I guess that will be September 9th, if I'm not mistaken. And that will be happening right when I will be on the ground at Finovate, and hopefully coming back with, as I always do, with interviews from, 5, 6 of my favorite companies that I saw there. And we'll be running those in the middle of September. If you happen to be coming out to Finovate, please drop a note. Please say hi. As I said, I know of several people who are waiting out there, and even beyond the companies, there's some other folks I wouldn't mind catching up with and getting some other thoughts, especially like I mentioned about Jason and his comments around the Wyoming stablecoin front token. You can always find out more about us at the website, and we can also reach us. If you've got any questions you'd like us to follow up on or give your thoughts about anything we talked about, we always love to hear from you. big-fintech.com. Just check out the media tab. You've got all our past episodes there. And listen to one of those if you like next week when we have our 1 week break, and we will see you in 2 weeks. As always, thanks for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big FinTech. Email info@big-fintech.com. Or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.